Do you agree that this is now a conversation that needs to be had?
Well, I think the markets have already absorbed the risk to some degree of an escalation even from these levels in the tariffs. But the overall macro effect so far globally, I think, is relatively modest. And so there's a multiplied effect through to profits. But at this stage, I don't think it will be very significant.
So, Peter, we were taken last week with a report from your team, actually, from you and your team, on the bull-bear indicator that Goldman Sachs maintains. And we'll put up a chart here, you know it well, that we're really up at the highest level since 1969, which at least historically would indicate we may be in for a rough patch here, I think it's fair to say. Explain that.
Yeah, absolutely. And I think there's sort of two ways of interpreting this. One of them is that we're at risky levels and there's a potential for a sharp drawdown in equities. The other is that we're at a point where we're likely to see a very significant slowdown in returns and we get a much flatter profile for equities. And it's the latter that we would think more likely. And one of the main reasons for this is that although this aggregate indicator is at very elevated levels, not every component underlying it is at such worrying levels. And one important one is inflation and interest rates. They are still, despite this very mature economic cycle, unusually low. Without them going up a lot, it's difficult to see a sustained drawdown in equity prices.
So if it does flatten out, as you say, is it the top line, revenue growth? Is it earnings per share because there's a limit to how much stock you can buy back and how much the tax cuts can have effect? What will cause that slowdown in growth?
Well, it's interesting. If you look at the anatomy, the contribution of the bull market since its low in 2009, roughly twice as much as average in this cycle has come from margins going up, and that's largely been because of technology contribution. And about twice as much as average has come from valuation expansion, which has really reflected the impact of policy, very loose financial conditions, low rates, QE. Actually, top-line growth has contributed around a third of its normal contribution to the equity bull market if you compare it to other cycles. So top-line growth has actually been unusually weak in all major markets, and that reflects really much lower inflation, the impact of disruptive technology on pricing and so on. And I think that will probably continue. So without the policy driver of valuation expansion, without technology margins rising much more, we would expect profit growth really to be driven by the top line, which is likely to continue at a relatively modest pace.
So what does that mean for global equities, Peter? I have a chart on my terminal, and I'll explain it to you. It just shows the U.S. outperformance versus Europe as well as emerging markets. The U.S. continuing to grind higher really ever since May. How do you think that plays out? The U.S. comes down to the rest of the world or vice versa?
Well, firstly, I think it's important to understand why the US has done so well, and it's not just since last May, it's really since 2009, and part of this has to do with buybacks being much more aggressive in the US than elsewhere. It's actually reduced the equity base in the US. If you take Europe, equity supply has actually increased in the last several years. Also tax reform more recently, but importantly the point I mentioned earlier, technology, which has a much bigger contribution to the aggregate index in the US. Nearly 30% of the index is made up of it, compared to around 5% in Europe. So that's been an important driver as well. Moving forwards, we would expect the differences to narrow a little bit, particularly on a shorter-term basis, where we think there's the opportunity for a rebound, particularly in EM equities, and I think Europe would benefit from that too. But as we look forward through next year, we think the differences will narrow quite a lot, and there won't be such big differences between the US and other global markets, in contrast really to what we've seen over the last few years.
So, Peter, in the short term, it's a question of how much money these companies are making, and they've been doing very, very well, particularly in the United States, but even globally. In the medium and longer term, it's also a question of what they do with the money that they make, how they reinvest it for the longer term, whether that growth pattern can sustain. What things do you look at to get a sense of the medium and long term, particularly capital investment?
Well, it's a very interesting point. We have different slices of the equity markets that we put together, which reflect the types of companies and what they're actually doing. And companies buying back shares aggressively, for example, in the US, generally outperformed quite significantly in recent years. Now we're finding that companies that are reinvesting for future growth in capex and R&D are generally outperforming, and that's true not just in the US, but, for example, here in Europe as well. So I think the markets are becoming more tolerant and, if not expectant, of companies using their cash a little bit more proactively to generate future growth, particularly so as global growth rates may be slowing as this cycle becomes very mature. So we do think that companies that can reinvest, particularly into businesses where there is an improving cash return on cash investment, that's a strategy that will be well rewarded, we think, by investors as the cycle matures.